Ever wondered how to pick the best North American dividend-paying stocks? Well, you're not alone. The world of investing can be a labyrinth of numbers, terms, and strategies, especially when it comes to dividend-paying stocks. These stocks, my friends, are like the golden geese of the investment world. They not only offer the potential for capital growth, but also provide a steady stream of income, regardless of market conditions. And that's precisely what makes them so appealing to investors. However, knowing how to pick the best ones, especially in the vast North American market, can be quite a challenge. That's where this video comes into play. Our objective is to help you understand the process of selecting the cream of the crop, the dividend-paying stocks that can potentially give your investment portfolio a significant boost. By the end of this video, you should have a clear idea of how to start your investment journey with dividend-paying stocks. First off, what exactly are dividends? Dividends are essentially a slice of a company's profits, distributed to shareholders as a token of appreciation for their investment. Imagine having a piece of pie. In this case, the pie is the company's profits, and the slice you receive is the dividend. The size of each slice depends on how many shares you own. The more shares, the bigger your piece of the pie. So why would a company choose to share this pie, their hard-earned profits? Well, companies that pay dividends are often stable and profitable, with enough earnings to share. It's their way of saying, thank you for believing in us, here's a piece of our success. Now, why should you, as an investor, care about dividends? One word: income. Dividends provide a steady stream of income in addition to any potential capital gains. This can be particularly beneficial if you're nearing retirement and looking for more predictability in your investment returns. And it's not just about the here and now. Reinvesting these dividends can significantly enhance your investment over time. It's a little like rolling a snowball down a hill. The further it rolls, the bigger it gets. That's the power of compounding returns. But what about companies that don't pay dividends? Well, they might choose to reinvest all their profits back into the business, fueling growth and, ideally, leading to an increase in the stock price. While this can be a profitable strategy, it's a bit more dependent on the market's ups and downs. So, dividends aren't just about immediate gratification. They're about long-term growth and stability. They're about sharing in a company's success today and reinvesting for even greater success tomorrow. Dividends can be a significant part of your investment strategy, providing a regular income stream alongside potential capital gains. So the next time you're evaluating a potential investment, don't forget to consider the dividends. It could be the cherry on top of your investment pie. Now that you know what dividends are, how do you identify stocks that pay high dividends? Well, it's not as challenging as it might initially seem. The key is to know what indicators to look for. Two of the most crucial indicators are dividend yield and payout ratio. Dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's calculated by dividing the annual dividend payment by the market price per share. A higher dividend yield could mean the stock is undervalued, or the company is doing really well and sharing its profits generously. On the other hand, the payout ratio is another significant metric. It's the proportion of earnings a company pays shareholders in dividends, expressed as a percentage. The payout ratio gives you an idea of how well a company's earnings support the dividend payments. More mature companies tend to have higher payout ratios. They have less to reinvest in growth, so they distribute more back to shareholders. But how do you find these numbers? Well, you don't have to be a Wall Street analyst with a Bloomberg terminal. There are numerous financial websites and tools available that provide this information. Websites like Yahoo Finance, Google Finance, and others offer comprehensive financial data for thousands of publicly traded companies. You can easily find a company's dividend yield and payout ratio there. However, keep in mind that while a high dividend yield is attractive, it's not the only factor to consider when choosing stocks. A company with a high yield but poor growth prospects or shaky financials might not be a great investment. Also, a company with a very high payout ratio may not be sustainable in the long run. If a company is paying out most of its earnings as dividends, it may not have enough left to invest in its own growth. So as with all things investing, balance is key. Look for companies with high but not excessive dividend yields and payout ratios, and always consider these numbers in the context of the company's overall financial health. Remember, a high dividend yield is attractive, but it's not the only factor to consider when picking stocks. Once you've identified potential high dividend stocks, it's time to evaluate the company behind them. This process is a bit like detective work, but don't worry, We're not talking about dusty files and trench coats here. Now, why is this evaluation important? Well, the financial health of a company directly impacts its ability to pay dividends. A financially unstable company might cut or eliminate dividends during tough times, leaving you, the investor, in the lurch. So, what indicators should you look for? The company's balance sheet is a good starting point. Consider its debt levels. A company with manageable debt is more likely to maintain or increase its dividends. Then dig into the company's earnings. Is revenue growing? Are profits increasing? If the answer is yes, that's a positive sign. It implies the company is performing well and could continue to pay dividends. Next, consider the company's payout ratio. This is the percentage of earnings a company pays out as dividends. A payout ratio of more than 50% might seem attractive at first glance, but it could also signal that the company is not reinvesting enough in its own growth. Apart from financials, you should also evaluate the company's dividend history. Has the company consistently paid dividends over time? Has it increased its dividend payouts? Consistency and growth in dividend payments are signs of a company's commitment to returning profits to shareholders. Now, you might be wondering, where can you find all this information? Most of it is available in the company's annual reports and financial statements, which are typically published on the company's website. You can also use financial news websites and investment research platforms for additional insight. Remember, the goal is not just to find a company that pays high dividends, but also one that has the potential to sustain these payments in the future. The company's overall health and dividend history can give you important clues about its future dividend payouts. Now you have some promising stocks in mind, but how many should you invest in? A crucial question indeed. Well, the answer lies in a concept known as diversification. Diversification is the practice of spreading your investments around to reduce risk. It's like the old saying, don't put all your eggs in one basket. Instead of investing all your capital in a single stock, or even only in high dividend stocks, it's often wise to spread it across a variety of investments. This could include a mix of high dividend stocks, growth stocks, and even bonds or other asset classes. Why is this important? Let's consider an example. Say you've invested all your money in the telecommunications sector because it offers attractive dividends. Now, what happens if there's a sudden downturn in that industry? Your entire portfolio would take a hit. But if you had diversified your investments across different sectors, the impact on your portfolio would have been cushioned. Now let's talk about balancing your portfolio. It's not just about having different types of investments, but also about the proportion of each. A common strategy is a mix of high dividend and growth stocks. High dividend stocks, as we discussed earlier, can provide a steady income stream. On the other hand, growth stocks, while they may not pay dividends, have the potential for substantial price appreciation. The exact mix would depend on your financial goals, risk tolerance, and investment horizon. For instance, if you're nearing retirement and need a steady income, you might lean towards high dividend stocks. But if you're young and can afford to take more risk for potentially higher returns, you might prefer a larger portion of growth stocks. So how many stocks should you invest in? There's no one-size-fits-all answer. A widely accepted suggestion is between 20 to 30 different stocks across various sectors. This number allows for diversification without spreading your investments too thin. Remember, diversification is key to managing risk in your investment portfolio. It's about balancing risk and reward and ultimately helping your money work harder for you. So, you're ready to start picking dividend stocks. What's next? We've journeyed through the basics of understanding dividends, identifying high dividend stocks, evaluating the company, and even managing your portfolio. These are your newly acquired compass and map in the vast world of investing. Remember, dividends are payments made by corporations to their shareholders, a slice of the profit pie. High dividend stocks are those that offer a greater yield, but they require careful selection. Evaluating the company behind the stock is crucial. Look for financial stability, a history of dividend payments, and a bright future. Diversification is key to managing risk. Don't put all your eggs in one basket. Spread your investments across different sectors and companies. With these tools, you're well equipped to start your research and embark on your investment journey. Investing in dividend stocks can be a rewarding journey. Start researching, stay informed, and you'll be on your way to building a successful dividend portfolio. Don't forget to subscribe to Caffeinated Money for more investment tips and strategies.